Welcome to the Keiser Report. I'm Max Keiser. You know, 7 people in Cambodia died of oxygen deprivation after climbing into a 15-foot deep well in order to retrieve 75 cents. In the global markets, an equally sad and deadly tragedy is brewing as trillions of dollars of investor wealth is thrown into the black hole of debt, seeking meager scraps of yield. And when deprived of the oxygen of income, similar tragedies will unfold, Stacy.
Yes, Max. Let's look at this first headline, and it's from the Financial Times. This weekend, Wall Street at fresh high in spite of low yields. What is unusual about that headline, Max?
Well, you know, usually the bond market and the stock market go in opposite directions. Here they're going all in the same direction because the Ponzi scheme that is the global stock market needs a bigger base on which to build higher and higher pyramids of debt. And they're using the bond market, the junk bond market, the super junk bond market. They're throwing everything they can at the banks to make it look as though there's some kind of foundation to this unbelievably leveraged Ponzi scheme that is the equity market. So both the stocks and the bonds are coterminous. They will both blow up simultaneously. Gold is also being manipulated down, and when this bubble pops, then the melt up in gold will shortly follow. I believe that the folks at the GATA, the Gold Antitrust Action Committee, would back me up on this. Chris Powell would definitely back me up on this over there at GATA. Gold is poised to spring into a melt-up phase as soon as the stock and bond bubble pop.
Now, most people out there will remember from 2008 when the stock market crashed, and on one day it fell by 1,000 points. That was when yields also dove and bond prices therefore went up because people were seeking safety. So right now you see the same thing where Treasury bond yields, the 10-year notes the yield is dropping, while the Dow and the S&P 500 are hitting record high after record high after record high. So one of those, somewhere there's a huge lie.
Well, it's not a flight to safety, it's a flight to junk. So junk bonds are yielding what government bonds were yielding 5 or 6 years ago. So it's a wealth confiscation scheme. As you point out at the top of the show in the teleprompter beginning, the fact is that people will dive into large wells to seek pennies. That's the risk-reward ratio of a bond today. For the 1 or 2% you get on that bond, you risk dying from income deprivation. On Wall Street, the saying is you're picking up nickels in front of steamrollers. That's kind of the way it's described on Wall Street. You know, the risk is not worth the reward. And this is a good situation, a good example of that.
Well, in fact, the article about those people in Cambodia reads, 7 die in Cambodia after looking for money in well. And one of the girls who witnessed this, she said, quote, "My youngest brother thought the amount of money was huge for poor people like us." So the 75 cents seemed huge to him because they were poor. But you could say the same thing that my broker thought the yield was huge in a days of 0% interest rates and QE and never-ending money printing.
Yeah, when they see a yield on a bond that's 2% or 3% or 4% on a junk bond, they think this is an unbelievably huge rate of return. They don't consider the risk. The risk is that the bond market collapses, as it does periodically along with the stock market, and you make 2 or 3%, but you lose 50 or 60%. Same thing in the housing market, the housing bubble in London. Similarly, people are chasing it at the absolute all-time highs, and when the pop comes in London real estate, we'll be sitting on 50 or 60% losses underwater, negative rates of return.
So one of the quotes from this article regarding all of these mixed signals coming out says that similarly, traditional indicators of uncertainty and market volatility have continued to reach new lows. The result is that too many participants are starting to confuse the decline in market volatility with a decline in overall risk. So that's another element to this, is that the VIX index is at all-time lows. The last time that they were at this low level was in 2007, right before the crash.
Well, this is an amazing development in modern financial engineering and derivatives. Before the VIX, the VIX, the volatility index, markets reflected more accurately, in my opinion, the true underlying volatility before this index of volatility came along. And suddenly there was a one-stop shop way to manage your volatility by buying or selling that index. Now, as Mitch Firestein has pointed out on this show, the volume in these contracts exceeds the volume in the underlying securities they are meant to track by a factor of 10 or more. That's clearly an example of mini puking, as we saw Barclays in describing their gold manipulation, or outright quote stuffing, or high frequency trading and quote stuffing. It's a manipulation. So by manipulating the VIX, you manipulate the perception. And when you manipulate the perception, you manipulate the market. Or you're just outright manipulating the market overall by understanding that these volatility index contracts are tied to the underlying securities, and if you can manipulate the index, you can manipulate the entire market. It's the tail wagging the dog, and that's the problem we've had in the last 20 years with the derivatives market, 100 times bigger than the stock market itself. If you can control the derivatives market by falsifying the action in the indexes that are supposed to apply to these markets, you can control the entire market. The Dow Jones is a great example. The Dow Jones is only 30 stocks, but if you can control or manipulate the Dow Jones, and this has been going on since the introduction of listed futures and options going back to the 80s. The S&P futures contract was a great source of manipulation back in my day in the 1980s. And the quarterly and monthly expiration of those options and futures were where much of the naked short selling and the portfolio insurance abuse took place leading up to the crash of '87. We saw the same thing in the crash of the dot-com in 2001. Saw a similar thing in the crash of the real estate market in 2007. And now we're leading up to a global crash for the same reasons. No regulatory authority has stepped in to stop this abuse, and the crash will be much bigger.
So not only are investors chasing yield in these junk bonds, but they're also chasing returns in junk, basically earnings reports out of the S&P 500 and the Dow and the Wall Street markets. The big hoax of the Wall Street hype machine, the S&P 500 index keeps bumbling from one all-time high to the next as corporations are issuing record amounts of debt to spend record amounts on buying back their own shares. $160 billion in the first quarter alone, according to Capital Q. Borrowing money to buy back shares and hyping it ceaselessly as returning value to the shareholders is the most effective way to manipulate up the stock, even if revenues are declining quarter after quarter.
That's right. The economy is shrinking. GDP is shrinking in America and in the UK if you adjust it for the true inflation numbers. So corporation stock prices would ordinarily go down. But since the interest rate on money is zero, if you're on Wall Street and you have good friends down there at Goldman Sachs, you can borrow $500 million, $10 billion, $500 billion, buy back your own stock. Now that same earnings number is divided by less shares, so magically, oh my God, we're making money. Our revenues are, our profits are increasing, which is a complete manipulation. Driven by debt, and the debt level in America has never been higher. The debt in the UK is 1,000% of GDP. When you add it all up, bank, mortgage, household, government. And the total debt to GDP ratio right now is 435%. Back in 2007, it topped at 403%. Okay, this is a figure, by the way, from none other than Nigel Farage, who happens to track this stuff pretty closely, and it's his clarity, I guess, that's driving a lot of interest in his campaign.
So I'll also explain here what they say in this article to encapsulate what you just said. In the climate of ZERP, any major corporation can do it. The heavy buying during these low volume times pushes up shares. The hype surrounding the buybacks pushes up shares. Expectations of more buyback announcements pushes up shares. The mere idea that shares are being pushed up pushes up shares. And in the end, the buybacks lower the share count for the all-important EPS ratio, the earnings per share ratio. But also what they're doing on top of that, manipulate it, is they're not using actual earnings, they're using forward earnings, which are like basically hoax. So he also has a chart here which shows you that the S&P earnings growth, the light blue is the estimated and the dark blue is the actual. So as you see, the forward earnings estimates are always like 50% higher than the actual once we get to that point.
Well, the forward earnings estimates can be discounted for an continuation of this manipulation. So they're saying we manipulated earnings this year, we're going to manipulate earnings next year. The granddaddy and king of earnings manipulation is General Electric. They have one of the biggest market caps in the world, and under Jeff Immelt, and then before under the neutron Jack Welch. They were famous for coming in with the exact number every quarter because they would manipulate those earnings. They'd hold back earnings or push forward earnings, and they come up with a number that's friendly for Wall Street, and they became the model for that earnings manipulation. So Wall Street is confident that there's no reason why they won't stop manipulating their earnings. The fly in the ointment is that if, oh my God, the global debt bubble pops. And then, of course, all these companies like General Electric, Warren Buffett or Berkshire Hathaway, or any bank on Wall Street or the City of London will say, A, we never saw it coming. That's a lie. B, we have no reason why it happened. That's a lie. C, we had nothing to do with it. That's a lie. D, we need another huge bailout, like Royal Bank of Scotland is now requiring another huge bailout because they've been lying every day since the initial bailout and for 5 years leading up to the bailout. Royal Bank of Scotland knew all-time high in number of lies from the CEOs and the board of directors from a single institution. They've somehow managed to take that top spot from some of the biggest liars in the history of corporate America in the world, including Enron.
So as the article had pointed out, there's record issuance of debt in order to buy back shares, which is all driving down the bond market as well. So the whole market is messed up. But
the demand for fraud has never been higher.
Exactly, but here we see in the next headline, U.S. bond market faces possible reckoning. A quote from David Keeble of Credit Agricole in the article says, "It's like playing a game of Russian roulette with the bond markets right now. You know something is going to go bang, and you just don't know when." So here, everybody is piling into all of these things that are about to go bang once again, which will lead to more bailouts, more bail-ins, more austerity, more of the same policies in which thousands of people have died from suicide and healthcare cuts, and like Greece, 40% healthcare cuts. And the same thing will happen, just like the stories.
Well, it's Simon Minsky's market instability theorem, where he pointed out the whole cycle of market instability. It goes through this exact same cycle. The markets begin to smoke their own belly button lint. They begin to believe their own lies. You know, even in the movie like Scarface, Al Pacino issues the dictum, never get high on your own supply. And then he violates that dictum spectacularly, and there's a blazing gunfire at the end of the film, and lots of people get blown away. Same thing with these markets. People say, you know, you shouldn't believe our own BS that we publish here on Wall Street, but they do, and markets hit all-time highs until there's that end, like, say hello to my little friend, called reversion to the mean.
Yeah.
And markets collapse by 60 or 70, 80%, and then all hell breaks loose. All right, Stacy, we got to go. Thanks.
See you, Max.
Stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Ian Fraser, author of this new blockbuster book, Shredded, Inside RBS, the Royal Bank of Scotland. Take a good look at this book because this is going to be skyrocketing up the bestseller list around the world. Ian, welcome to the Keiser Report.
Thank you, Max.
All right, when we talk about the Royal Bank of Scotland, of course, the name Fred Goodwin comes up. He's kind of the key player. It's been a couple of years since the whole thing went down, but just fill the folks in on Fred Goodwin and mention some of the excesses that you detail in the book about Fred's behavior.
Okay, well, Fred was an accountant. He became the chief executive of RBS in March 2000. He was a deal monger. He made loads of takeovers of other banks, which he didn't properly evaluate prior to the acquisition being carried out. Classic example was Charter One, Cleveland Bank, which he bought in 2004 for $10.5 billion. It was later revealed to be worth about $1.5 billion, or about that. So, you know, he massively overpaid for it. He loved all the kind of trappings that went with being the head of a global bank, because he loved having, you know, fleets of Mercedes. He loved the private jet.
Yeah, I get the impression in reading the book he becomes like a ghetto pimp. You know, he becomes ghetto rich. You know, and these pimps, they make a few bucks and they get the flashy car and the fancy fur coat and, you know, they strut around the ghetto. So here you have the ghetto of financial fraud, and there's Fred Goodwin, you know, flashing his cash like a pimp. And the rest of the banking industry, they emulate that. They're like, you know, yeah, we want to be pimps too. So HBOS, you know, when we've had Paul Moore on the show, the whistleblower, about how HBOS was a turn into a hellacious whorehouse of debt. And then you've got also Neil Mitchell, who talks about the RBS becoming a whorehouse of debt. But this is really the definitive text. I think of Barbarians at the Gate that came out about Colbert, Craverson, Roberts, and the RGR Nabisco deal. This is going to be a classic. It's an instant classic. So I just want to skip to the present because this RBS scandal is growing. They quote, RBS could fail with 100 billion pounds of black hole today. The British taxpayer is in line to lose their entire 45 billion pound stake that they used to bail them out. Talk about it.
The problem is that when Gordon Brown bailed out the bank in 2008, he didn't properly sort it out, and nor has Stephen Hester, the guy who was the chief executive from 2008 through to 2013. There's still some serious issues, some serious problems inside the bank. There's a lot of misvaluation of assets still, I believe. There's also a lot of, I call them unfunded liabilities to do with future litigation, which relate to LIBOR. They've already been fined, massive amount of money for fiddling the LIBOR rate. But the true fallout of that hasn't fully been felt. There are quite a lot of court cases ongoing in the US whereby they could lose up to 80 billion if, according to one analyst called Sandy Chen, just on those court cases alone. That's just for LIBOR. They also have a current ongoing criminal investigation involving multiple regulators around the world into market manipulation of foreign exchange rates, spot rates. This could have serious consequences for RBS. There are also ongoing inquiries into money laundering by its US arm, Citizens Financial, which, by the way, might become very difficult to sell because it failed its stress test for the Federal Reserve stress test earlier this year. So there are a lot of these sort of submarine issues within the bank, which they don't fully fess up to, relating to past misconduct. And the misconduct didn't solely happen on Fred Goodwin's watch. A lot of it carried on, or in fact got worse, after Stephen Hester took over as the chief executive.
Let me jump in, because you on that list of wrongdoings, one stands out: mispricing assets. So here we have this ongoing theme of mark-to-model versus mark-to-market. In other words, you have a bank, they've got assets on their books, they submit to regulators what they believe these assets are worth, and they claim they might be worth 100 cents on the dollar based on a model. But the resale value of these assets might be only 5 cents on the dollar. And this is a pattern of fraud and abuse. And it's not by accident that they are mispricing these assets. They're doing it on purpose. Now, they would claim, I believe, that they're doing so because they got the advice from their accountants. Who is RBS's accountant?
It's a firm called Deloitte, who have been the accountant since 2000. It's quite interesting about that.
How is it different than Arthur Andersen and Enron? Arthur Andersen and Enron, they cooked Enron's books for years. Then suddenly they said these assets are worth nothing, and the bank vaporized in a day. Why is RBS and Deloitte & Touche not the exact same thing played out over again?
I think it's partly because it was bailed out by the government. Therefore, the government has a vested interest in perpetuating the misrepresentation of these asset valuations. Because the government now has an 81% stake in RBS, it doesn't want to admit the real state of its balance sheet, the truth. What is very odd about the bailout was that they retained Deloitte. They didn't fire Deloitte on the 13th of October 2008 when they gave it the largest bailout in the world. They actually kept them on. Now, that is very strange, considering presumably Deloitte had been doing a pretty bad job of auditing this bank when it said it was making profits of 10 billion.
Okay, you say it's doing a bad job. Okay, but isn't that just a euphemism for criminal behavior? Because they get caught, as does PricewaterhouseCoopers, KPMG, and Ernst & Young, with repeatedly a serial abuse of the law. They appear to be serial financial lawbreakers. So, and the government is in bed with Deloitte & Touche.
Yes.
On this occasion.
They are.
Given the fact that the taxpayer owns Royal Bank of Scotland, isn't that an offense under some kind of offense above and beyond just incompetence? Doesn't it kind of qualify as something more severe?
One could argue it's a fraud on the public. I mean, one could argue that, but if I had been Gordon Brown and if I had been bailing out RBS on the 13th of October 2008, I would have fired Deloitte. I wouldn't have kept them on. I think they had not been doing their job properly as auditors of that bank. And the statements that were published for the accounts up to December 2007 are, in my view, fraudulent.
It's funny because the Royal Mail just went public in this country,
Yeah.
and Lazard Frères was the bank who advised them on that.
Yeah.
And it turns out that Lazard stole £8 million on that deal.
Yes.
Okay, so then the government didn't even ask for that money back. They just gave him a pat on the head and said, "Thank you, Lazard, for stealing £8 million. Have a nice day."
There's a serious issue here with the government basically, not standing up to what could be deemed financial crime or financial wrongdoing. It seems to be very tolerant of that, and I think that's a serious issue for the UK.
I don't understand what justification they use to perpetrate these financial crimes. Now, you've got yourself, by the way, on Twitter, you've been very active in keeping track of all these crimes. This book, Shredded, Inside RBS, this is the book that you need to get. I think it's available only in hardcover at the moment. So you're going to have to actually carry this book around. It's not on ebook yet, but it'll give you a sense of the gravitas and the seriousness of this tome. And the government here, the coalition government, and the Brown, bailout at the time, the current financial system, because there was no reform, because there was no attempt to regulate the regulators, and because these big four accounting firms have been allowed to run amok, the current crisis in the UK, it looks like this. It looks like RBS is going to have to be bailed out again.
Yes, it's quite possible. And I don't think the average UK citizen realizes the gravity of the situation. I think they've, to a certain extent, had the wool pulled over their eyes. I mean, I may be wrong. Maybe Ross McEwan has completely turned the place around in the past few months. It's possible that the bank isn't in quite such a bad state as I'm making out. But I do believe there are a lot of unresolved issues to do with criminal penalties, forthcoming ones, to do with litigation, to do with redress, to do with compensating customers who were swindled, both post and pre-bailout, which have not yet been fully taken into account when they work out their provisions for future legal redress or criminal penalties. So this is the issue that I was highlighting in that Independent on Sunday article last Sunday, which Tom Harper wrote.
Let me just look at this kind of in a broader context for a second, because when you talk about financial fraud and financial crimes, the grist of that fraud is cheap money, cheap interest rates. And of course, that's the province and purview of the Bank of England that keeps rates near 0%. They claim that they need to do so to keep the recovery going, and yet all the thing we have in this country growing is debt. Jobs market is anemic, except for temp jobs, part-time jobs, low-pay jobs. And GDP is now being boosted by things like prostitution and cocaine use. That's the new government policy. Have you looked at, does the book get into, and have you looked at the relationship between, let's say, an RBS, one of the biggest banks in the UK, and the central bank, and the quid pro quo that goes there? Keep rates low so that we can commit fraud more easily and more frequently.
I do look at that kind of cozy relationship between the government, the Bank of England, and banks, including RBS. And it's very, very unhealthy, you know, as we saw during the LIBOR revelations of summer of 2012, when it became evident that the Bank of England was almost condoning, if not encouraging, banks to lie about their LIBOR numbers. So there are some serious issues about the crony capitalist approach, whereby the government exists almost to help the bankers, not to help the people. And I think this is something which needs to be addressed in the UK and other countries.
Now, Neil Mitchell's been on the show. He's a whistleblower as well on Royal Bank of Scotland.
Yes.
And he focuses on the Global Restructuring Group, which is a subsidiary that's been basically, it's like their mafia, pet mafia, that they go out there and do leg breaking and asset stripping on companies that they cut credit off, and then when they're dying from credit, they pick off the assets cheap. You cover it in your book as well, Global Restructuring Group. Can you, so Neil Mitchell's been pretty thorough about this.
Yes.
Is there anything in what Neil Mitchell's been saying that you would disagree with, and can you add to that?
One thing I would add is that I think that there is evidence to suggest that in some instances they deliberately kneecapped customers, business customers, who they didn't particularly like, not because they were badly managed or they were not creditworthy, but they just took a scunner or dislike to these companies. They kneecapped them, and through various techniques, including phony valuations, valuations which were, say, half or a third of the actual valuation, so that they could pretend the company was in breach of covenant. And then, to do a favor to a larger customer who they value much more, they could then sell that business or the assets remaining of that business to the larger company at a discount.
All right, so pure favoritism, crony capitalism. They just said, I don't like the way you looked at me at the club, so I'm going to bankrupt you, type of thing. Now, before we started, you said there were some late-breaking ideas and news. Can you fill us in on that? We've got about a minute. Okay,
well, the key thing is that in the Clever Chance review that came out in February, the bank claimed there was no evidence of systematic fraud or systematic wrongdoing within Global Restructuring Group. But we have just this morning I've discovered there is evidence that a school in Sheffield was misvalued. The school was originally valued in December 2009 at 1.05 million, and less than a month later, on the 27th of January 2010, the same school was valued by West Register Realizations, which is part of RBS, at 500,000 to 600,000, so half. The next day after the valuation, the second valuation was done, a letter was sent to the chairman of the governors of this school. It said, right, we're transferring you to GRG. So literally one day after the letter, after the valuation, which was, in my view, deliberately low or fraudulent, a letter is written to the chairman of the governors saying, we're transferring you to GRG, and then it's sold for 600,000 to West Register Realizations.
All right, well, Ian Fraser, the book is called Shredded: Inside RBS, the bank that broke Britain. Thanks so much for being on the Keiser Report.
Good to see you.
All right, and that's going to do it for this edition of the Keiser Report. With me, Max Keiser, and Stacy Herbert, I'd like to thank our guest, Ian Fraser, author of his new book, Shredded. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.